Brian, what is the main difference between funding a permanent life insurance policy and funding a retirement account?
Yeah, there's different ways to save up for retirement. You can do your typical retirement accounts, like your 401k. So you can either put money into the 401k as a deductible contribution or as a Roth 401k contribution. So with the deductible one, you get tax benefit now, and you get to grow that account tax deferred. You will pay tax on it someday when you take it out. But while it's growing, you're not paying tax, so that's an advantage. The advantage to the Roth is, even though you don't get a deduction when you fund it, when you do take the money out and all the growth that it has, it's tax-free. So that's great. That's a great thing to have. Now, you also could put money into a permanent life insurance policy. That also can build up cash value over the years and do it in a tax-deferred manner. And in fact, when you take it out, if you do it properly, you could have tax-free income during your lifetime as well as a death benefit.
So that's going to be the main difference between those two, is the death benefit on the life insurance policy. And as you said, if I'm understanding you correctly, you can take proceeds from the life insurance policy tax-free.
Yeah, you can. If you have the build up there, and you can borrow against your own future death proceeds as a tax-free cash flow. Now, the reason I wanted to bring these up together is it's not either or necessarily. It can be both. So, for instance, I've had people come to me and they say, well, I couldn't save up enough for retirement even though I made a lot of money. I said, well, why is that? They said, well, I was limited to whatever the limits were in their plan, call it $10,000 a year. That's all I could put away. I said, well, you could have put money outside of your retirement account away. And the person looked at me and said, I never even thought about that. And it was, oh, okay. I would have thought you would have, but yeah, they were in their 60s and they had a couple $100,000 put away is all, but they didn't do anything in addition to that. So a lot of people are making good money these days, and maybe you have a tech job or something else that pays really well, and you're thinking about your retirement in the future, but you're kind of maxed out on how much you can put away in your 401k plan or your simple plan or whatever, or maybe you don't even have a plan. And so if you have additional money to put away, you might want to consider permanent life insurance, because like a Roth contribution that grows tax-free, permanent life insurance has similar attributes, but there's no limitations on how much you can put away into those things. Whereas the Roth and the 401k, they have limitations. The permanent life doesn't. So a lot of people might consider using both or all three that I mentioned in their retirement plan.
Brian, if you're a younger person out of those choices, which would you say is the best choice?
Probably, well, I sure like the Roth. The Roth is going to grow tax-free permanently, and if you invest it somewhat aggressively, you might have a lot of gains that are tax-free. If you have loved ones you want to take care of someday, the permanent insurance can be really good. They're all good. I'd like to have all of them. I'd like to have choices. You know, I could take some deductions now on deductible contributions, have the Roth, have the permanent life insurance. Again, there's no limitations. So the example I would say is, like you say, you have a high-paying job, and gosh, I'm putting some money away, but that's not going to get me there, just that amount of money for a retirement when I want to retire. And so, as I mentioned, you can use that permanent life insurance, and maybe you're maxed out at, say, $20,000 a year in your 401k, but you know you could put away 50 grand a year. Well, you might decide to put 30 into the fixed index universal life policy, the permanent life insurance, because you can't add any more than that 20 to your 401k plan. So you might consider that as an alternative investment.
Brian, thanks for telling us more about funding a permanent life insurance policy in addition to a retirement account.